Well, hello everyone. Brett Hirsch here, and I just wanted to say Merry Christmas. If you're watching this and it's past Christmas, Happy New Year. I hope everybody had a great year and had a wonderful Thanksgiving, and I hope you're excited about 2017. So, first we got to deal with 2016. So I thought I'd throw a few last-minute tax tips together for you, a little bit of last-minute tax planning for individuals. Before we proceed, before I proceed or you proceed, just remember this is for informational purposes only. Does not constitute tax advice. Remember, taxes are very complicated, so do not act on this or any advice without first seeking qualified professional assistance. And remember, advice is often worth what you pay for it. So let's look at the tax savings here. How much can you save from some last-minute deductions or last-minute reductions in taxable income? Well, that savings is really going to depend on your tax bracket. And usually we have a marginal tax system. So really it depends on where your final dollars are coming in that marginal tax bracket. But in general, per $1,000 decrease in taxable income is going to save you between $100 and $390 in federal tax. And also remember, if we're able to reduce items on the first page, or if you're able to reduce items on the first page of your tax return, your 1040, oftentimes it'll also save you in state taxes. Not all the time, but some states like mine, which is West Virginia, their taxable income in West Virginia starts with your adjusted gross income from your federal return. Other states vary a little bit to allow you to itemize some deductions. That's not true here. Some states have no tax at all. But just remember, we can save you in federal and state, or you can save in federal and state with some last-minute effective tax planning. First tax planning tip, retirement contributions. You got a 401k or similar account, take a look at it and see if you've maxed it out yet. Even if you haven't maxed it out, you can go through your last paycheck or last few paychecks, go to whoever you need to go to, and so you want to increase the contributions for those last few paychecks. That's going to decrease both your federal and most likely your state, depending on your state income. You save taxes. So what you need to do that is you need to talk to your administrator, your payroll administrator, or your human resources department. Now, if you don't have a qualified plan at work, a traditional IRA deduction, you want to make those, save you some taxes. You have up until the due date of the return, which is April 15th. Now, if you're going to do that, or you hope you can do that, plan ahead. Save the money up if you don't have it now. If you've got some time, you can save up to $5,000. You can contribute up to $5,500 per person, or $6,500 if you're 50 or over. They'll allow you an additional $1,000 catch-up contribution. And as you said, that could be a lot of tax savings from doing that. Plus, it's your money you're saving for the future. However, remember, if you already have a retirement plan at work, just remember to talk to a professional first, because this gets really complicated. You may not be able to contribute anything to a traditional IRA. You may be able to contribute some amount, but that amount may be limited. There's many factors that can influence that. So talk to a professional. Charitable contributions, another tax tip. You got to make them by the end of the year. Generally, you're going to have to itemize deductions to take advantage of this. So if you're somebody who doesn't itemize deductions, this may not be as beneficial for you tax-wise, but it's always a good idea to give. It's always a good idea to have a giving heart. Now, one little thing I want to tell you here, it's not little, it's really important. If you're over age 70 and a half, and let's say you've paid your house off and you don't itemize because you no longer have that mortgage interest deduction, tax law right now allows you to make a contribution from your IRA directly to your church or your charity, as long as that check, you don't touch it, as long as it goes directly to that organization. It'll come out of your IRA completely tax-free. So in effect, you do get a deduction. Remember, your charitable contributions have to be made to a qualified organization. You can contribute cash or check, or you can make a non-cash contribution. If you're going to contribute cash, I hope you don't. Now, you can also do a debit card or credit card also. That'll give you more of a paper trail. But cash generally is more difficult to track. Regardless of how you give, remember, you must have a receipt to claim the deduction. Make sure you keep your receipts. There's special rules also. If your non-cash contributions exceed certain thresholds, there's more substantiation requirements. So you may be more records you're going to have to keep. You may have to jump through some more hoops to get to deduction. Also, with regard to vehicles, have become a little complex in recent years. The charity is going to they'll actually tell you what your deduction is more or less. So just make sure you get all the information, get a receipt or the additional information you may need from the qualified organization. Next tax tip, look at your portfolio, take some losses. If you got some loser stocks, sell them. You can, if you don't think they're going to come back, or you can wait till like after 30 days, you can buy the same stocks back if you think they're going to stay low, or mutual funds or whatever. Anyways, I'm getting ahead of myself here. Losses up to $3,000 of capital gains you can claim each year on your tax return. You can also offset other gains. So say you make $10,000, you get $10,000 losses, you can pull $10,000 of gains out tax-free by offsetting them with your losses. Also, if you have some carryover losses, remember any losses that exceeded $3,000 in a prior year, you carry forward to the next year. You may have some carryovers that you can take advantage of and in effect cash out some of your winners. The stock market's up right now. Take that money out tax-free, depending on your individual facts and circumstances. Long-term capital rates, as you may know or you may not know, those are lower rates, usually between 0 and 15%. Some of you folks out there, if you're in a 10 to 15% tax bracket, you may be able to actually have capital gains on sales of stocks and not pay any taxes at all. For most, however, you're looking at 15%, unless you're in the top tax bracket, it goes up a little bit. Next tax tip, defer income. That means postponing income to the next year. This is a very good tax tip. Remember, but you have to do it right. Big difference between tax avoidance and tax evasion. So be very careful here. And postponing income to the next year, deferring income is usually a good idea. If next year you're going to be in the same or a lower tax bracket, of course, you'll be taxed the same rate next year or a lower rate the following year. What's that mean? You save taxes. So you might be able to do this with bonuses at work if it's a policy of the organization where they'll give bonuses the following year. That may be like instead of a Christmas bonus, they give you a New Year, Happy New Year bonus. Good luck doing that because they don't claim the expenses this year. So that may not be their advantage. However, if you're taking out IRA distributions, as long as you take out your minimum distribution, you can wait till the following year to take that money out, which means it will be taxed later. Also investments, things you have control over. Investment sales, like we mentioned stocks earlier. If you have some short-term stocks that you want to sell, if you can just hold off to the next year, you're going to postpone that earnings. Anyways, if you're self-employed, billing for services, you may want to bill a little later in December. So you're probably a cash basis taxpayer, so you receive that income the following year. Also, remember, if you're going to take that route, you're self-employed, holding a check doesn't count. If you get the check, it's income. It doesn't matter when you deposit. So if you have a small business and you receive the checks in the mail, you're going to have to claim it as income. Making deposit doesn't work. The IRS knows that folks do that, and they'll catch you pretty quick. Okay, 529 plans. Doesn't necessarily save you on federal taxes. However, it can save you on state taxes if it's state-sponsored. You can give up to $70,000 per child. That's a pretty good bid, isn't it? $70,000 per child, usually where they max out per child. I believe that's in total contributions. However, remember, if you're given more than your annual exclusion for gifts, our contributions of 529 plans are considered a gift. So if you go over that gift tax exclusion for your annual exclusion, you can't have a gift tax issue. So use that as $14,000 per donee per child is what it is, like right now. If you go over that, you may have an issue. Flexible spending accounts, the final tax tip here. If you have one at work, I want to make sure that you look and you're putting money in a flexible spending account. Make sure you use it. Generally, these are employee funded, as you may know. The money you put into that account, if it's used for certain things, you can use it tax-free. It goes into that account tax-free, and that doesn't include Social Security and Medicare. So it's a very tax-free way for most folks who have them. You can pay for, if your employer has to offer them, of course. But you can pay for generally child care, dependent care related expenses, and also medical is a real big one. So check to see if you have a flexible spending account. Make sure you use that money up because you're going to use it or lose it. And we want you to use it before you lose it, which generally means it'll go back to the employer. So that's it for our final tax tips for this year. I hope everybody has had a great year, very Merry Christmas, and a very Happy New Year. Looking forward to seeing you soon.